Well, hi everyone. I hope you all are doing well. We're coming here. Oh, it's about Tuesday night at about 9 o'clock. I've had another 12-hour day. It's been a kind of long day for me. I'm sitting here in my living room, and for the rest of this semester, until further notice, we're gonna do these classes by way of this type of video. Um, thank God for my daughter. And you know me, I have trouble using my cell phone, let alone doing anything from a technological perspective. But my daughter was able to, excuse me, was able to set this video up and by something, put it on another format to then transfer it to Blackboard. And so this lecture will be available to you. Um, Lecturing in this format in accounting is a little difficult. I don't have a large blackboard. I don't have some of the tools I think to be effective to really go through um, and explain some of the accounting concepts and principles. But what I did do is sometime this evening, I sent to you basically a recap of this lecture for tonight. And hopefully, if you're following along, if you can follow along, it will be helpful for you. Now, very important is please communicate with me. I have another class in Jersey City, and I've been doing this for 3 weeks now, and I've had two students that have contacted me. So, let me know. Are this effective? Are there other things we can do to make this effective? At one point, let me know what's going on. You're okay. You're working. You're not working. Um, Keep in contact with me. I think that is so important during these times. I want to know how you're doing. I want to make sure that you're getting something from these lectures, that these lectures are in fact effective, that my materials that I've given to you are effective, and if not, I'll try to come up with a different format. But until further notice, this is the format that we have, and so we will get by. I told my class earlier today, we've gone through some very difficult times as a nation, and we'll overcome this. That's no reservations whatsoever. I think I told you I'm also a history teacher, history professor. I teach history, and considering some of the other times, this is really nothing. We will get through this. Um, but again, please communicate with me. Now, one thing I have to tell you, I was I was so pleasantly surprised with your exams. I mean, I knew this was an extremely bright class to begin with, but I have to tell you, I'll be very honest with you. I was really amazed at how well this class did. I mean, I've two students actually got an A plus. I can assure you, in all the years of teaching, I don't recall any class in which two students got an A plus on an exam. A, hopefully it means that I'm doing a very good job explaining the material. B, I hope this is not the case, that the exam was too easy. However, to alleviate my concerns with point two, I can assure you the next little quiz is going to be a little bit more challenging. Challenging. Because I was very, very pleased. You should all pat yourselves on the back at how well you did. Um, I don't think there was a grade less than a B or a B minus. So I was very, very pleased at how well you did. I can assure you, in teaching this class for, I don't know, maybe 10 years now, I've never had a class do as well on the first exam. So good for you. You worked hard. Pat yourself on the back. All right. I want to just once again to go through. By the way, tonight we're going to just spend a little bit of time. If you look at my lecture materials here, I want to spend a little time on adjusting entries, just because we ended up with adjusting entries. Now we've been through this before, but I just want to reinforce this to you because we will see these adjusting entries on your next exam. Um, when we talk about adjusting entries, remember, we are making these entries to adjust certain accounts to accurately reflect the account position at the end of the month. Okay, it accurately reflects. If we don't do these adjusting entries, our books and records are wrong. They are overstated. Okay, now we have several examples, and of course, the first one we talked about was this concept of prepaid insurance. Think about it. You paid your insurance for the entire year. You paid your insurance for 6 months, for 3 months. This concept of prepaying an expense in advance is actually an asset. Again, although it's not allowed here in New Jersey, think about, let's say you paid your rent a year in advance. Well, it's really an asset because now you paid it, you live free, um, for the year. Think of car insurance. Think of health insurance. So you basically have taken one asset, cash, and you have created another asset, which is some type of prepaid expense. Um, so we've been talking about what's most common is this idea of prepaid insurance. Again, it's an asset. Prepaid insurance is an asset that reflects the fact that you prepaid the insurance for a period of time. Now, I think in the example I gave you, I said on April 1st, 2020, you purchased insurance for 6 months for $2,400. So, at one time, if you paid your insurance in advance, you got some type of discount. I don't think they do that anymore. I think just the opposite. If you don't pay your insurance in advance, there may be a fee. I know in my malpractice insurance, if I pay it all up front, fine. If I pay it in monthly installments or quarterly installments, they charge me a few extra dollars. But in this case, on April 1st, you prepaid insurance for 6 months. So again, your entry, you're going to debit prepaid insurance, you're going to credit cash. Again, think about the scale of justice here. Okay, we're still in balance. Why? Prepaid insurance is an asset, cash is an asset. You are debiting an asset, you are crediting an asset. Okay, so we're still in balance here. We have not come out of balance whatsoever. So on 4-1, you took cash. By the way, could you use your American Express card? Absolutely. If you use your American Express card, it would still be prepaid insurance, debit. You would credit American Express payable, something like that. Yes, you can. But again, that insurance here in this example is for 6 months. So now the end of the month rolls around. So if you think about it, you have used up 1 month of insurance. Again, you purchase this insurance 4-1. 4-2, if you decide, hey, I'm going to get rid of this car, you get your money back. But if you had this insurance for 30 days, you actually have used up 1 month's worth of insurance. So what you need to do at month end is you need to do this adjusting entry. You need to reflect the fact that you used up 1 month's of prepaid insurance. So on 430, what is your entry? You're going to debit insurance expense. It reflects the fact that you had insurance expense for the entire year. What is your credit? Prepaid insurance. Folks tend to make the mistake of crediting cash. No. When you purchase the insurance policy, you are paid cash. You're not paying cash again. You are reducing your asset of prepaid insurance. Now again, think of our scales of justice. Okay? You're reducing your asset prepaid insurance. What is an expense? An expense is a reduction in our owner's equity position. We're still in balance. All right? Okay, hopefully you've gotten that concept. Number 2, salaries. Now, again, if you're paid on a monthly basis, this is probably not a problem. But if you're paid on a weekly basis or if you're paid every 2 weeks, conceivably this could be a problem. Why? Well, think about it. if I'm paid on a weekly basis, I get paid on the 7th, on the 14th, on the 21st, on the 28th. But let's say twice a month, I get paid on the 14th and the 28th. But if you think about it, I get paid on the 28th, but what about the last few days of the month? Do I owe my secretary or my staff, my employees money? I do. Am I going to pay them? Absolutely not. I'm not going to pay them. I'm not going to pay them till the next pay cycle. But I have to reflect the fact that I owe them money for the last few days of the month. If I don't do that, my books and records are not correct. So in this particular example, my employees get paid every 2 weeks. They get paid on, in this case, they get paid on April 14th and they get paid on April 28th, the sum of $2,000. So now I pay them on 4/28, $2,000, but what about 4/29 and what about 4/30? 2 days. If I don't make this adjusting entry, I've understated or I failed to reflect the fact that I owe my staff money. So now what I need to do on 4/30, I need to do an adjusting entry. Now, think about it. If I owe them 30 days in April, so I owe the 29th and I owe the 30th. I owe 2 days. Now, if the entire cycle, if the entire pay period, 10 days is $2,000, divide that by 10 days, it's actually $200 a day. So I have to make an entry to reflect the fact that I owe my employees $400. Hopefully you understand the math there. So what do I do on 4/30? I make an entry to debit salary expense. Salary expense for the 2 months. But then I have to credit something. What am I going to credit? Now, right away, you want to credit cash. Absolutely not. I am not paying my employees cash, but I have to set up some type of credit entry to reflect the fact that I owe my employees money. What do I set up? I set up a new account called salary payable. I debit salary expense, $400. I credit salary payable. If I don't set up that liability, my books and records are not correct. I'm not accurately reflecting the fact that I owe my employees money. And as you see, the next pay period, when we ultimately pay cash, we're going to wipe out this liability. Okay. Second entry that we talked about was the issue of supplies. Now, again, we're going to purchase supplies during the course of the month. Now, somebody did something very interesting on the exam, in that they expensed all their supplies. I thought to myself, but if you look at the problem and you read the problem, you could say, well, yeah, I can understand why instead of putting those supplies as assets, you expense them right away. So that was a pretty good way to approach this. In this particular case, though, our supplies are going to be deemed to be assets. And on 4/1, we bought $1,500 of supplies. On 4/10, we bought $1,000 worth of supplies. On 4/25, we bought another $1,500 of supplies. So during the course of the month, we purchased $4,000 of supplies. Okay? But as we know, we have to count. We have to check. We need to know how much of these supplies remain. If we don't make this adjusting entry, if we don't do this inventory or this count, our books are going to reflect the fact that we use none of these supplies up, which in any legitimate or operating business would be illogical to make that assumption. So on 4/30, we do an inventory. And 4/30, what we discover is that there are $2,500 worth of supplies left. So we bought 4,000 during the month. We have 25 left over. Therefore, we've used up $1,500 worth of supplies. So on 430, we have to do an entry to reflect the fact that we used up these supplies. What is our entry? We're going to debit supply expense, and we're going to credit supplies for $1,500. Now, please, people want to reverse these. The $2,500 is left over. What we've used, what we've expensed, is the $1,500. What we've used up is deemed to be the expense. Okay. The next adjusting entry is the concept of depreciation. Now, it's an easy concept, although many of you will struggle with this. And again, just look at it from the perspective, you purchase something. As soon as you take it home and you use it once or twice, it's declined in value. Whether we like it or not, assets are going to decline in value over time. We have to reflect the fact that our assets have declined. And so what we do, we use a formula for depreciation. By the way, all different types of depreciation, we're using what is known as a straight line depreciation. It's going to be consistent. And that is, the formula for depreciation is cost minus salvage value over useful life. Cost, what did it cost? Less salvage value. So when this asset is deemed to be junk, it's deemed to be obsolete. What value is there in this junk asset or this obsolete asset? Divide that over an industry standard known as useful life. How long would the average asset be worth or usable to the business entity? So it's cost minus salvage value divided by useful life. Now in the example, April 1, I go out and I purchase something that I've wanted for quite some time, is I purchased my Lexus convertible. Now notice, I purchased it, I didn't pay all cash for it. I cashed in what? I took out a car loan. So on my books and records for 4/1, I set up I make the entry, auto, Lexus. The purchase price, the cost was $42,000. I then credit cash for $15,000, and I take out a loan for $27,000. So that's my entry to reflect the fact that I had bought my Lexus convertible. But now, at the end of the month, I have to reflect the fact that my Lexus has declined in value. So what do? Well, my example says that my Lexus has a salvage value of $6,000 and my useful life for my Lexus is 6 years. Cost minus salvage value divided by useful life. So in this case, the cost was $42,000 less $6,000 divided by 6 years. If I do the mathematical equation, that gives me $6,000 a year in depreciation. And of course, I divide that by 12 because I'm doing this entry on a monthly basis. That means each and every month I depreciate, or my Lexus depreciates $500. So on 430, I have to do this adjusting entry of depreciation expense, Lexus, of $500. And then my credit is going to be this account, this contra account that we've established, and that is accumulated depreciation, Lexus. By the way, I probably should spend a little bit more time going through how this accumulated depreciation should be reflected in the balance sheet, and I'll probably do that next week. And then finally, we have the account allowance for doubtful accounts. Allowance for doubtful accounts is an expense that you must adjust your books to reflect the fact that a creditor is not going to pay you. And the example I gave on 410, I sent out a bill to a client for $2,500. So, of course, what's my entry? Well, in the accrual method of accounting, my entry is on 410. I put accounts receivable, $2,500, and I credit professional fees, $2,500. I reflect the fact that I've billed, services have been rendered, now I'm waiting to get paid. But then, wouldn't you know it, on 428, I'm sitting there, I'm reading that horrible paper, the Bergen Record, and what do I see? Oh my God, my client filed a Chapter 7 bankruptcy petition. He filed complete liquidation. If you know anything about bankruptcy, what's the chance of me getting paid? Probably slim or none. So now what am I going to do with this receivable that I set up on my books? Am I ever going to collect that receivable? The answer is probably not. So once I discover that this is not going to happen, I have to do an adjusting entry. And what I do, I set up an account called Allowance for Doubtful Accounts. Allowance for Doubtful Accounts is an expense account. It will be in my income statement. I put allowance for doubtful accounts and expense for $2,500. What is my corresponding credit entry? It's my receivables. So if you look in your T account, you're going to have a debit in your receivable T account for $2,500. Now you're going to have a credit. Therefore, what am I saying? That receivable is now zero. Think about it from an income perspective, an income statement perspective. I have an expense account for $2,500. I have a professional fee entry for $2,500. They wash each other out. If I don't do this, then clearly my books and records are not correct. All right. If you go to problems 4A, 6, and 8 on page 99 and 101, those are some adjusting entry problems that you may want to work on, and I'll certainly, if you work on those, I'll do those problems for you. In addition, I've given you a rather lengthy homework problem that I'm going to ask you to do also. All right, just a quick break. Hold on, quick break. Sorry, you didn't see that. The next topic we're going to talk about is this issue of accounting for cash. Cash. As I told you from the start, my favorite all-time asset is cash. But as you may know, cash has a tendency to do something. What does cash have a tendency to do? To disappear. You ever notice in your checkbook or your bank account, oh, you think you have all this money, and the next thing you know, oh my God, what happened to all my money? Well, think of it from a business perspective. You need to have some control over your cash position. The book talks about establishing what is known as a system of internal controls. That is, policies and procedures that you are going to establish and put in place, clearly designed to safeguard and monitor your assets, especially your cash position. I spent 7 long years of my life at a very large public accounting firm, and much of what we were doing at the time was establishing policies and procedures, particularly policies and procedures dealing with cash and other liquid investments. Some examples are, you may want to have a double signature. So before something is paid, 2 people are going to sign off on the check. 2 people are going to look at the bill and make sure that the correct amount is being paid. Very common is to divide up responsibilities. You may have one person maybe opening up envelopes, another person maybe writing the deposit slips, and then a third person that's actually going to do the physical deposit in your bank, whether online or physically going to your bank. Uh, Probably the most common control over cash is to do a monthly bank reconciliation, and we're gonna talk about those bank reconciliations. But you need to be able to control your assets, particularly control your cash position. If not, I can assure you it's very easy to uh, to lose control and have your cash disappear. Um, One control that's often used, or um, if you ever worked in the retail sales business, you may have worked with a cash register. Um, and each and every sale is rung up in the cash register. And it's quite common practice. And then what happens is at the end of the day, you hit the sales total button. And what happens? All your sales in your cash register comes out on the cash register tape. That cash register tape is actually a source document. It's an independent document. That'll tell you what all your sales were for that particular day. So at the end of the day, you close, you hit your sales total register button, and then all your sales are printed out on your register tape. Now, what should happen is that total on your cash register equals the total of cash in your drawer. If you've done everything right, you've accounted for every sale. When you hit that button, your registered tape prints out what your registered tape tells you. Registered tape is the source document. What it tells you should total sales should equal the cash in your drawer. That's what should happen. However, unfortunately, that often doesn't happen. What happens a lot of times is you have differences. And here's where we have to be careful. Why are we having these differences? Now, this is a control factor to control because we don't want this to get out of hand. So if we constantly are having these differences, then maybe, just maybe, we have to take a look at that employee, or maybe, just maybe, we have to take a look at our policies for handling these sales transactions. Now, an example I gave you, the register tape, the manager hits the register tape, and it prints out and says that we have $3,600 of sales. Okay, it was a pretty good day. But then we count the money in the drawer, and the money in the drawer discloses to us that we have $3,400. So wait a second, we have a little bit of a problem here. There's a $200 difference. What happened? What happened here? Was it a simple error? Or God forbid, was it something worse? Was it something criminal? So you now need to go back to find out, hey, listen, was this a one-time deal? Is this continuing? But more importantly, where was the breakdown of controls? What was done? Where was the failure to account for each and every cash sale? However, we have a situation now. Our cash register tells us one thing, and our cash in the drawer is something totally different. So on 330, we have to reflect the fact that we had cash, we're going to deposit cash of $2,400. So we're going to debit cash of $3,400. We're going to reflect the fact that we had $3,600 of sales. Don't forget, that's our source document. That's what we're going to reconcile to. So our sales are $3,600. Hey, wait a second. We have a difference here of $200. That difference is going to be reflected in our journal entry in a new account called cash over and short. Cash over and short. Cash over and short is going to balance the cash position on our register tape as well as the cash position in our drawer. Now, keep in mind here, and I hope I made this clear as I can, when cash over and short is a debit, when cash over and short is a debit, that is, our sales are greater than the cash in our drawer. When our cash over and short is a debit, it is considered to be an expense account. It will be located in our income statement as an expense. Why? We have to reflect the fact if the source document is the register tape, we have to reconcile to the source document. So in this case, the source document, the register tape says with 3,600, we have 3,400 in cash. Therefore, we're going to debit cash over and short for $200. It's going to balance out the entry. But if you think about it, the cash was 3,400. On our income statement, we're going to show sales of 3,600, but we're going to show an expense of 200. 36 minus 200, it gives us the $3,400, which is ultimately the cash that we took in. Now, it can be reversed. People say, "What is it better to be short in cash or long in cash?" Either way, it's a problem. Whether you're long or short in cash from the register, that reflects the fact that there's a failure in your internal controls. So again, you have to look at your employee or you have to look at your system for recording or handling these sales and the cash exchange. Now, in the second example, we had the register tape said $3,300, but when we counted the drawer, it had $3,700. That's kind of alarming because that leads me to believe that someone is not recording all your sales. And that can have implications up and down the line, particularly implications for your income statement. But in this case now, we have cash at 37, we have sales at 34, so there's a $300 difference. I'm sorry, $400 difference. 37 in cash, 33 in sales. We have a $400 difference. So what we're going to do, we're going to record the fact that we took in $3,700 of cash. We're going to reflect the fact that our sales are $3,400, $3,300. But then we're going to have another account called cash over and short for $400, which is going to balance out the journal entry. Now keep in mind, when cash over and short is a credit, it's considered to be a revenue account. So when cash over and short is a debit, it's considered an expense account. When cash over and short is a credit, it's considered to be a revenue account. And look at it this way. You have sales of $3,300. You have cash over and short, which is a credit of $400, $3,700, which agrees to the cash that you took in. Okay, this is going to be a constant problem for people that are working in retail. And that's something that you are going to, you will have to be working with. You're going to be working with when you're working in any retail position. Now, I had two other topics that I wanted to talk tonight with you, and I don't think I brought them home. But the one topic dealt with the concept of cash. Now, it's not so unusual for you to have numerous cash accounts. Again, at one time, if you opened up a new bank account, you got something. You got a I don't know, you got a toaster oven, or you got. I remember my father used to get not a six pack, but a carton of cigarettes. Banks would give out if you opened up a new account. So it's not so unusual to have your account cash in one bank, but then decide you're going to open up another bank account. Um, Now, when we talk about cash transfer, keep in mind that our cash position, overall cash position, is the same. The only difference is we're taking it out of one bank and we're putting it in another bank. Not so unusual. Now, I don't have it in front of me, but I think the example that I sent to you was the business had their account at Bank of America. Now, why anyone would deal with Bank of America is beyond me. Probably one of the most difficult institutions that I've ever had to work with. I'm at a point now, me and another prominent attorney here in Bergen County, we're just about ready to sue Bank of America. We're trying to resolve a $9,900 estate, not 99,000, not 9.9 million, but $9,900. We're trying to resolve it on behalf of a client, and we can't do it. Why? Because of the inefficiencies and stupidity of the Bank of America. Anyway, in this particular example that I gave you, I think we said that Bank of America, we have our account at Bank of America. And I think the example was, and again, I don't have it in front of me, was that we had $8,500 at the Bank of America. And we decide ultimately that we are going to open up an account with Valley. At one time, Valley was managed by Jerry Lipkin. I knew Jerry Lipkin because probably 25 years ago, if not longer, Jerry Lipkin approached me about joining him in this new company, this new bank of his, which was Valley National Bank. Jerry Lipkin was a very good friend of a friend of mine, my old boss at the World Trade Center. Jerry Lipkin was an auditor for the Office of the Comptroller of the Currency. And when Jerry was there, I kind of liked Valley National Bank. Jerry subsequently left. I don't particularly care for the new policies of Bank of America, but I think the example was that we had $8,500 in Bank of America, and what we want to do is Valley National Bank set up a new bank kind of close to the office. So maybe we want to open up a bank with them and try them and see what their services are like. So what we do is we're transferring cash from Bank of America to Valley National Bank. Now it's simply a cash transfer. Our overall cash position is the same, but we have to reflect the fact that we've taken money out of one bank and put it in another bank. Why? We're going to talk a little later about doing bank reconciliations. So we need to be able to, on our books and records, we need to be able to reconcile what we have in one bank on our books and records versus our bank statement. So we're taking, I think it was $2,500. Again, I could be wrong, but I think it was $2,500 from Bank of America to Valley. So what do? We have to set up an entry to reflect the transfer. And what we do is we go cash, debit, cash, Valley National Bank or Valley, reflecting the fact that we'll have cash of, I think it was $2,500 in Valley. We have to credit something. What do we credit? Cash, Bank of America. So now if you look at it, our overall cash position is still the same, $8,500 I think it was. But now we've broken that cash up into two banks. Now Valley has $2,500 and Bank of America has $6,000. So our cash position remains the same. It's just the idea that we've divided it into two separate banks. So what do? Anytime there's a cash transfer, where the money is going to, that bank we're going to debit. Where the money's coming from, we're going to credit. Again, the entry is still cash, and cash. We're going to debit cash. We're going to credit cash. We're going to debit cash, reflecting the bank that the money is going to, and we're going to credit cash, reflecting the fact that we've taken money out of this bank. Now, there's another type of, all different types of cash transfers, but some smaller companies, and your book talks about it, they establish what is known as a petty cash account. By the way, I don't think this is a good idea. But what a lot of companies do is they basically put an envelope aside or they put a drawer aside for cash in the odd chance that they need small amounts of cash to do something. I think the example that I gave you was you're working late, you need to get a project done, and the manager decides he's going to buy pizza for everyone. He buys four pies, and with the tip, it's $50. Now, when the delivery kid comes, he doesn't want a company check. That's ridiculous. So what some companies do is they have a drawer, or they have an envelope of cash in which for small disbursements, they can take money out of this drawer, take money out of this envelope to pay for a small expense. So I think the example I gave you was it was $50 for the pizza and tip. So what we would do is we would debit miscellaneous expense. I don't like that term, but we would debit some type of expense, miscellaneous expense, and we would credit petty cash. Now, how would that petty cash develop in the first place? Just like any other cash transfer. Remember we had that account at Bank of America? So if we were transferring from Bank of America to this petty cash fund, what we would do is we would debit petty cash to reflect the fact that we're putting monies into this petty cash fund, and we would credit whatever bank we were taking this money from. Simply cash transfers. Okay, if we don't do that though, when we go to reconcile, we're going to see that our Bank of America position is going to be overstated. Why? We have these other cash bank accounts. Now that leads us to something that, again, I don't have it in front of me and I apologize to you, but the idea of doing a cash or a bank reconciliation. Now why I bring this up to you is because in some smaller law firms, paralegal does everything. In particular, the paralegal may in fact have the responsibility to reconcile the attorney's business account, but more importantly, to reconcile the attorney's trust account. So it's kind of important that you know how to do a bank reconciliation. I cannot believe, excuse me, pardon me, I'm going to go from the screen here. Sorry, it's late, I had a tough day. In some smaller firms, you have the responsibility, and we're going to talk about the trust account. You cannot screw up the trust account. And how a lot of you don't even reconcile your own bank account is mind-boggling to me. But when we do this reconciliation, there's a formula that we're going to use. And it's a relatively simple formula. And that is, we're going to take our bank statement. Don't forget, that is an independent source, is that bank statement. From that bank statement, we are then going to deduct out the outstanding checks. We're going to add our deposits in transit, and that's going to give us our adjusted bank statement balance. Hold on a second, I'm running low on power here. Sorry, had some technical difficulties here. Okay. All right. So again, we're going to take our bank statement. Don't forget our bank statement that we received. It's an independent document, and that's what we're going to reconcile to. So we're going to take our bank statement. We're going to add our deposits in transit. We're going to subtract out our outstanding checks, and that's going to give us our adjusted bank statement balance. Then we're going to take our checkbook. We're going to take our checkbook. We're going to subtract bank fees. Bank fees are terrible. Bank fees are absolutely terrible. But we're going to subtract out our bank fees. We're going to subtract out checks that were returned for non-sufficient funds, checks that have bounced. Unfortunately, it happens. We're going to subtract out our bank fees, subtract out our bounce checks. We're going to add or subtract credit memos or debit memos. A lot of times we get wires into our account. So we're going to subtract or we're going to add credit or debit memos. And then we're going to subtract or debit any type of accounting or mathematical mistakes that we've made. If we take our checkbook, we subtract out our fees, bank fees, we subtract out checks returned for non-sufficient funds, we add or subtract debit or credit memos, we add or subtract any errors that are made, that ultimately is going to give us our adjusted checkbook balance. If we did this right, our adjusted checkbook balance and our adjusted bank statement balance are going to equal. And it's going to be amazed when we do this. Now, again, I had it in front of me. I don't have it now. But there are a series of problems that I'd like to point out to you. If you go to your book, there's a series of problems. By the way, in some of the materials that I sent to you tonight, I've actually done a problem for you involving a bank reconciliation. I forget which one I did, but I think I have asked you to do, I think it's 5B14 and 5B16, I think. Just check the homework that I gave you. But if you look at the formula that I've set up, you'll be able to do this without a problem. And that's going to be pretty important. We're going to see it's going to be very important that you do a reconciliation. I'll tell you a terrible story that happened to me. I handled a matter. It was late on a Friday, and I wired a rather substantial payoff to a bank, and this was late on a Friday. The following week, I got stuck in a terrible, terrible court matter. So I was gone for probably 4 days the following week. When I came back to work that Friday, I just happened to get my bank statement, and I began the process of reconciling. Again, I may have the dates screwed up, but I got my bank statement, and I began to do a bank reconciliation, only to discover that I never made that payoff. Now think about it. My client thinks that this obligation has been paid in full, and it's not. Clearly, it was my error. We're going to talk about handling a trust account, and the biggest mistakes that an attorney can make is not pay an obligation on behalf of a client in a prompt manner. Certainly one ways to get jammed up. Clearly it was an error on my part, but we're going to see it doesn't make a difference. Anyway, it cost me about $3,600. It was my fault. I thought the wire went out. It did not go out. It cost me about $3,600, but I often think if I did not, on a timely manner, reconcile my bank statement. If I would have waited a month or two, it could have cost me $20,000, $30,000. So that's why it's so important that you institute these controls, um, and you engage in reconciliations, particularly of all your bank statements. That is very important. You'll find all the errors that have been made. Um, It'll give you an idea of the flow of your cash position. And if you follow that formula, it'll be a relatively simple thing to do. Remember, you take your bank statement, you add your deposits in transit, you subtract out your outstanding checks. That gives you your adjusted bank statement balance. That's your source document. That's what you're reconciling to. Then you take your checkbook, you subtract out fees, you subtract out bounced checks, you add or subtract credit, debit, or wire memos coming in and out of your account. You add or subtract any errors that you may have made. That will give you your adjusted checkbook balance. Again, if you do this right, and you will be able to do it, you will in fact be more. You will you will be so proud of yourself that you were able to do this, and it's a relatively simple thing to do if you follow the formula that I've given you. All right, it's now about 10 to 10. I've been up since about 5:30, um, so we've gone for about an hour. What my plan is to kind of do more problems with you, just as I would do in class, but since I don't have a blackboard, I'll do them in the office and I'll send you problems. Now, I've given you, if you look at the stuff that I sent you today, I've given you a large problem and I've given you, I think, 4 or 5 book problems to do. So if you can knock those out, email me if you have any problems doing it. Um, but this is the format that we're going to go. I don't think it really does us much serves much of a purpose if I do this for 2 or 3 hours, although it wouldn't really bother me at all. Um, Under the circumstances, I think it's best that I talk for about an hour or so, maybe a little longer, but then supply you with the problems and answers to the problems that I think you'll get more from. Just to continue on, next week we're gonna continue with cash. We're gonna talk a little bit about payroll, not a lot about payroll, um, but then we're gonna end the accounting portion of the class, and then you know what that means? That means we're gonna have a second exam. Now, considering how well you did on the first exam, the second exam will in fact be more challenging. I want to challenge you. I know you can do this. I knew from the start you can do this. Please remember I told you this numerous times. George Bush once said that low expectations is a form of bigotry. I'm not a bigot. I only have the highest expectations for you. You can do this. You've shown me you can do this. You've shown yourself you can do this. So we're going to have another exam, not next week, but the week after. Then after that, I'm going to get right into something that I think is very important. And that is I'm going to show you how to do a real estate closing by 2 reconciliations, 2 T accounts. You heard such horror stories about doing a real estate closing. And I'm going to show you, just like I did today, I had like 3 real estate closings today. I'm going to show you how I do it, how easy it is to handle a real estate closing. I know many of you may have had mechanics or thinking about taking mechanics. And at one time, part of the mechanics of property transactions is you actually got you got a program that prepared either the HUD one or the closing disclosure statement. Things are changing. When I first started in real estate, you had a closing statement that was 1 page. Then you went into a 2-page HUD statement. Then you went to a 3-page HUD statement. Now we're into a 5 or 6 closing disclosure statement. It's just a nightmare. But regardless, I'm going to teach you by 2 reconciliations how to do a real estate closing. Um, you know, all due respect, any porcupine could punch a keyboard and put numbers in a box, that doesn't mean anything. What's important is you know where these numbers come from and what these numbers are made up of. So once we conclude the accounting portion, by the way, we are going to talk about some of the ethical consequences of handling the trust account. We're going to get right into the handling of real estate closing simply by two reconciliations. Um, I did this 2 years ago when the Bar Association was in. They actually came to my class, and they were pretty impressed with the fact that I was actually teaching students how to do this. They thought it was kind of a novel approach. It really isn't. It's actually a pretty simple thing, but that's what we're going to be focusing in on. All right? Okay, email me. I've given you problems to do. I'm working all weekend, so you can certainly get a hold of me. And any questions, let me know. All right? And hopefully, this format is something that you can handle and it's going to be worthwhile for you as we complete the semester. All right? It's 10 o'clock. Um, it's Coors Light time. So you have a good evening, and I will talk to you next week.